Welcome back to Turning Hard Times into Good Times. Well, folks, Alasdair Macleod is with me. Alasdair, are you there?
I'm here, Jay.
Oh, you're over across the pond, over there in England,
Yep.
in Brexit country.
Yes.
So, thanks for being with us again, Alasdair. You've been a guest here for many times, so I won't take the time to read your bio, other than to tell people that goldmoney.com, you provide a lot of commentary there, a lot of very valuable essays there that I think people should partake of. I wanted to ask you today. You know, we talked to Michael Oliver a little earlier about this apparent breakdown between stocks and bonds, where we used to see money coming out of stocks going into bonds and vice versa. Now it seems to be on down days you see money coming out of both stocks and U.S. Treasuries. What do you make of that?
Well, I think it's quite simple. The very, very low yields on sovereign debt basically give the valuation to equities. Equities are not taking their valuation from underlying performance. I mean, the fact is that the few equities that pay a dividend nowadays pay a dividend which is probably greater than what you can get on a sovereign debt, whereas in the past it used to be the other way around. And in a normal cycle, when sovereign debt tops out, it tops out because there's demand for money, businesses picking up for businesses and so on. Mm-hmm. So the emphasis shifts towards equities. This time it's absent, which actually I would have thought is rather worrying.
I think it's rather worrying. Just really wondering, I saw your colleague James Turk, an article at King World News. He said the world is headed for a crisis far worse than 2008, and he wondered what excuse the Fed would have would use to avoid raising interest rates the next time. Now, I believe tomorrow there's a rate decision, I believe, at the Fed. What are your thoughts on that? Will they or will they not? And if they don't, again, because they keep trying to prime us all for rate rises, and then tomorrow never comes, it seems.
My thought is they won't, but they should. The reason they should is actually quite simple. If you look at the LIBOR, US dollar LIBOR rate, it has been rising quite sharply. The word is that the rise in LIBOR has actually got to do with money market funds switching from prime lending into buying government debt. There is obviously some truth in that, and it's ahead of regulatory changes next month. But having said that, LIBOR has actually been rising for some time, and I don't think that's the only reason. The other thing I would draw your attention to is if you take M2, money M2, subtract from it money M1, you end up with a rough proxy for bank credit, and that has been growing above trend all this year. So I put the two things together, and I see a higher level of LIBOR, US dollar LIBOR, and an expansion of bank credit, which tells me there is demand for money out on the street. On that basis, price inflation is likely to pick up next year beyond the Fed target by a reasonable measure, and the Fed should be anticipating it. But so far as I can see, the Fed isn't watching this at all.
Well, yeah, I mean, they had a 2% target. I think I saw something about 2.3 already or something like that. No, that's the anticipation.
Precisely. And it's going to rise further than that, I think.
Well, I mean, why do you think the Fed won't? Because they're afraid of the stock market?
I think they are. I think they're afraid also of getting, if you like, a bond bear market going. Look at it this way. Bonds are so wildly overpriced that if they just return to normal, the fall in the value of bonds, particularly in the European banking system, would probably wipe out some systemically important banks. So we've got to the point where we cannot actually afford to have a bear market in sovereign debt. And I think that's very worrying. It's very restrictive. I don't know how we get out of this.
I guess what you're telling me is that not even the gods of the Federal Reserve and the Bank of England and the JGB can fool Mother Nature, in essence. So we've had this bull market in stocks, this bull market in bonds, which is largely, especially since 2008, 2009, so artificial, right?
That is correct. It is entirely artificial, as the whole of monetary policy is artificial, and that's what's driving prices. The idea of negative interest rates is frankly ridiculous. Yet we have, until recently, I think we had over $13 trillion worth equivalent of bonds on negative yields. I think it's fallen a little bit because of the slight correction in bond markets over the last 10 days or so, but it's still completely ridiculous. I mean, would you pay someone, to take your money and to use it? No, you wouldn't. You would expect an interest return. I mean, it just stands everything on its head. It is a complete lunacy. But how do you get out of that? That is the problem. They've ended up at a sort of endpoint from which there appears to be no escape. I'm sure that this week we will get some hints of more dramatic, extraordinary measures. Goodness knows what they will be. But I think they've just driven themselves into a cul-de-sac from which really there is no escape.
Yeah, the lunatics are in charge of the insane asylum, as they say.
Yes.
You have so you have this possibility of even minuscule rate rises, not only smacking stocks down, but you could see a huge avalanche of loss of confidence in the debt markets, huh? And
you could. Yes, you could, Jay. I mean, it's the underlying problem is we've had an expansion of the total quantity of debt, which has been unremitting and pretty well exponential for the whole of this century. I mean, I know the century is only 16 years old, but it has been at least that, if not longer. And we haven't had a sort of a washout, if you like, a crisis to force the reallocation of capital from businesses that do not deploy capital effectively to those that will use it effectively. The result is the underlying economy has really become very inefficient on the whole. And that is why we're getting no economic recovery at all, despite these lower interest rates. I mean, the whole system is effectively maxed out already and can't do anything with it. The other side of that is that if they start raising interest rates, the question then is, how far do they raise interest rates before they trigger the next slump? My guess is probably somewhere between 1.5% and 2.5% on the Fed funds rate. No more than that. That's not a lot of headroom.
That's incredible. That's just incredible that you can't that the economy can't take more than that because of the dislocations that have been created through this funny money that's been thrown out there. Well, I guess maybe that I didn't. I'm not sure the entire content of James Turk's article. I don't know if you saw it, but it certainly would seem to me that. That what the picture you're painting there with the dislocations, the structural problems that we have globally in the monetary system, that could set the stage for something very, very ominous. Nobody wants that to happen, but it is what it is, right? I mean,
I think
something worse than 2008. Is James overstating it? Is he being a little bit, promotional there?
I don't think James is overstating it.
No, he's not inclined to be over promotional. I know him personally. He's not like that.
No, exactly. I think it is right to say that the succeeding crises that we had, and if we look back to the time when Alan Greenspan was there, we had the post-dot-com bubble crisis, if you like. Then we had the property crisis, the subprime loans and all the rest of it in America, which led to the Lehman crisis. And this time round, I mean, those two, the first one was bad, the second one was awful, this third one is due to be even worse. And the question then arises, where is it going to start? I think the central banks can probably hold things. I mean, if we get a banking problem, let's say in Europe or something like that, I have no doubt that they will rescue whatever systemic banks need to be rescued. But the problem is, the underlying problem is the economy. I mean, the economy in Europe is in really a terrible state. I'll just quote to you the situation in Italy.
Sure.
Just look at that one. In Italy, the non-performing loans are roughly, I think it's something like 18 or 19% of GDP. Now, when you take into account that 52% of GDP is government, none of that is non-performing loans. The non-performing loans are in 48% of the economy. Yeah. The non-performing loans represents very, very close to 40% of the private sector economy. How do you recover from that? And this is assuming, of course, that the non-performing loan figure is accurate, and it's not worse than that. It could well be. In fact, it's likely to be. Oh. So, you can rescue the banks all you like, but the problem is the underlying economy is in deep, deep trouble. And I think that Brexit, thank goodness we have said Brexit from my, in my opinion, but we're not going to get out of there for another 2 years. I think various other countries are going to start sort of thinking, well, should we really be part of this? And not only that, but the people on the ground are beginning to rebel as well. I mean, you've heard about Greece and Portugal, sure. You're very much aware of. The Italians as well, as they've got a referendum coming up, and Matteo Renzi has said that if it goes against him, he will resign. That's what he first said, but he's been clawing back on that. I don't think he's going to resign. He realizes that this actually could be very, very serious. France is full of people who want out. Marine Le Pen is the most popular next president nominee. I mean, she's way ahead of Sarkozy and way, way ahead of Hollande in the popularity stakes as the next president. And Merkel has, I'm afraid, she's having a very bad political result as a result, principally because of the immigration problem. So I think the old order is in great difficulty, and not only that, they are beginning to panic, I think, when it comes to trying to keep the whole show on the road.
How are they going to do it is the question, because as you point out, the real economy ultimately is what supports all of these programs that the government has put in place, and these guys have gained power and have put themselves in privileged positions. But once you destroy it's like the parasites have eaten away at the flesh, right? And there's nothing left to create cash flow to service the debt. The debt hasn't gone away. The debt continues to grow exponentially, almost, it seems, with every problem. And I would go back to 1987, Alasdair, when the plunge protection team was put in place after the stock market crash of 87. And ever since then, the market has never been allowed to go back to anything resembling normalcy, I think. Back to equilibrium.
Well, no, you're right. I think the fundamental problem in terms of imbalance in this is that you've got basically one lender and a whole load of borrowers. The lender is Germany, and everybody else wants their money. They've taken too much money, which they can't repay. Germany doesn't want to write its money off, yet the crunch is coming. I think the ECB is probably in the firing line to try and hold the situation together as much as possible, but they can't do that indefinitely. And I think, coming back to the basic point that you're saying, we were talking about the Fed, I think that the major central banks actually do know that this is a major problem. And please don't rock the boat. And I think that's where they are.
Do you think, Alasdair, that's why they're getting ready for a cashless society? Are they getting ready now for a real totalitarian play, a power play, where they don't allow you to have anything to do with your own money, with your own wealth? They basically have said, we want control over everything you do. They're certainly starting to lay the groundwork for getting rid of the bigger bills, the hundreds and I guess in Europe they got rid of the 500s, right? And what are they doing there? Because the cashless society is what's being proposed by the, supposedly the most brilliant people on earth, the same people that have put us into this mess.
Yes, you're absolutely right. And I think the feeling I get is that most central banks, even in some of the emerging economies, are planning on a sort of 5-year timescale to do away with cash. I mean, it's completely ridiculous. The Swedes tried it, I think it was last year or was it the year before, and had to backtrack. I think it's a step too far. But the reason they're doing it is really quite simple. It does give them the flexibility to go further into negative interest rate territory. But I think they're probably backing off from that idea insofar as it just hasn't worked and they can see distortions being created in the market. I think the other reason they're doing it is actually a very, very simple one, and that is as long as you are forced to keep your money within the banking system, as long as you're forced to keep your money within the banking system, then the central banks can always rescue the banks. There cannot be a run on an individual bank which is destabilizing, because it gets recycled through the money markets. But when you queue up and you draw physical cash out of the bank, it's a very, very different thing. That is what creates a run on an individual bank. And I think that the central bankers are very, very aware of this danger and want to prevent it.
Well, they certainly are. I think certainly are aware and certainly concerned. With just a couple of minutes left, BitGold, gold money, now BitGold. Alasdair, is it true that those people who had their gold at Gold Money before, that's James Turk's creation, Gold Money, which is now merged with the BitGold, and now they call the whole entity Gold Money. Is it possible now to take your gold from Gold Money, transfer it to the other accounts at Gold Money, at the BitGold accounts, and then use it as a payment system?
We haven't yet set up, if you like, a sort of a complete flow through, but it is on its way. So if you have any listeners who have accounts with us, who have both accounts, as indeed I do, it is on its way. I'm very sorry it's not there quite yet, but we are working on that.
So the way it works now is you'd have to sell your gold at the old Gold Money account, and then buy gold again and put it in the other account if you wanted to do it that way. That's the only way you can do it now. You can't just simply transfer the grams of gold from one account to the next.
Yeah,
but that's on its way.
Yeah, I think, yes, it's on its way. I mean, there has been an awful lot of integration undertaken between the two sides. What we've now rebranded as Gold Money Wealth, and the BitGold side, which is now rebranded as Gold Money Personal. There has been a lot of work on integration, and that is continuing. And I hope that facility will be with us very, very soon. So,
all right, we'll have to let it go at that, Alasdair. We're out of time. Thank you so much for your patience and for being with us again. I hope we can do it again sometime soon.
That's been my pleasure, Jay.